Welcome to our LVC on income tax. And today our topic is income from other sources. But as it happened in the previous class, some part was left and there was sudden internet failure at my end. So I'll complete that part first. And then we will move on to another very interesting topic in Income Tax Act, that is income from other sources. Also, now since we have completed our capital gain, kindly start solving sums from various materials, firstly module, then MTP, RTP of the previous exam. I think that would be sufficient to give you a hands-on experience. And as we have already done sums in our class also, which I had shared, so I'm sure all these things put together would be adding great value to you. So yes, very good morning, Krishna, Anchal, Sridhar, Mehak, Vishakha, everyone, very, very good morning. Let me start. Anyone having any doubts or questions, may please put it across. So we were discussing some special cases of computation of capital gain. Yes, students. Anyone having doubts, please ask. No queries? Okay. So let me proceed. Now the next special case in capital gains is relating to one specific situation of non-residents. Now let us say you are a non-resident who has invested in our Indian stock market. Now as government, we would definitely want foreign investors to invest because that also increases the volume in our markets, that also help our domestic players in the market. So to lure them and to give them a special advantage, a provision was incorporated in Income Tax Act, which said that if non-residents are investing foreign currency, how they are investing foreign currency? By purchasing shares or debentures of an Indian company. So what the government is trying to achieve, one, they want foreign investments. Two, they also want foreign currency. So if they have purchased the shares, debentures in Indian company using foreign currency, then whenever in future they will transfer these shares, they will sell these shares, then this special provision will apply. Now, what does this special provision says? So this special provision is given in proviso to section 48. Now, what does this special provision says? Now, this provision says that where a non-resident has purchased shares or debentures in Indian company through foreign currency, right? Now, in such cases, whenever these shares are sold, so whenever this non-resident will sell the shares, how will we calculate the capital gain? So our normal format is FVC, expenses on transfer, net consideration, cost of acquisition, and then capital gain. Now, what is the special point is that they are saying we will first compute your entire capital gain in the foreign currency in which you have procured. So let us say you purchase this using dollars. So today when you sell the shares, whatever is your full value, expenses, cost, all these things will be converted to the foreign currency. When you do this, the resultant capital gain will also be in foreign currency. But since we are talking about taxes of India, we need the figure in Indian rupees. So we will convert this foreign currency capital gain into rupees. And this final amount will be treated as your final taxable capital gain. Now, what is so special in this is, if you observe, these two transactions have happened on the date of transfer, and this transaction has happened on the date of purchase. So you have purchased the shares, let us say in 2018-19, and you have sold it today in 2025-26. Now, what has changed between this particular two dates is the rate of foreign exchange. Now, what they are saying that these two figures which are happening today, that is expenses on transfer and the full value of consideration. Now, let us say today in the share market, they are selling the shares. They are receiving money in rupee term. They are paying brokerage to the broker. All these are in rupee terms. You convert it into dollars. How? By taking the average exchange rate. Of which date? Of this date. And whatever was your purchase cost, you will convert that also using the average exchange rate. The only difference is this average exchange rate be of the date of purchase, because this transaction has happened at the time of purchase. This value is of purchase date. So take the average exchange rate of the date of purchase. So in this fashion, you compute the capital gain in foreign currency. So the difference figure will be in foreign currency. Now convert it into Indian rupees, taking the telegraphic buying rate on the date of transfer, that is today's date. So this is what is the special provision given in proviso to section 48 for non-residents who had purchased their shares, debentures, by investing money in foreign currency. So this is what is this special point. So all the figures, cost of acquisition, expenses, everything, full value of consideration, everything has to be converted to foreign currency. This will be done by taking the average. Now, average of what? Average of two rates. One is the telegraphic transfer buy rate. One is the telegraphic transfer sell rate. So these are the foreign currency exchange rates. Take the average of this and convert this. And finally, the capital gain that you will arise, you will reconvert it to Indian rupees by taking the telegraphic transfer buying rate on the date of transfer. So this is how there is a special provision for computation of capital gain for non-residents. Is this clear to all students? Understood? somebody had this as a question also in the previous class. So I had said that I'll explain it when we will be dealing with the special scenarios. Right? One more special scenario is left, which is also important. Yes. Now, what is this scenario? 1 second. Yes. Anshul, what you did not understand, beta? Arun is asking, is this available only for long-term capital gain? No, Arun, that is not a, if you're asking for non-resident, that is not a condition put over there. So, Anshul, see, you have your value in Indian rupees. Let us say today you have sold the shares for rupees 10 lakhs. So you have this Indian value of 10 lakhs, which is your full value of consideration. Now, today's stock market or today's this RBI's exchange rates are published. And you have two exchange rates given, buy rate and sell rate. Banks always have two rates. Take the average of both the rates. Now, let us say today's average rate is rupees 100 per dollar. Now you have sold it for rupees 10 lakhs. So divided by rupees 100, you will get the amount of full value in dollars. Same thing, you have paid today 5,000 as brokerage to the stockbroker. Divided by 100, you get the value in foreign currency. This is how you convert all the values of your shares, the purchase value, the sale value, into foreign currency. Now, all the three figures which we require in computation are in foreign currency. So, full value minus expenses minus cost. This is your amount of capital gain, which is now in foreign currency because all the figures are in foreign currency. Let us say it comes to $4,500, for example. Now this $4,500, you again convert it into Indian rupees by multiplying by today's telegraphic transfer buying rate. That is again the foreign currency rate given by bank. So 5,000 multiplied by 100 will give you the amount of final capital gain or loss on this transaction, Anshul. So basically, by providing this method for non-resident, what indirectly the law has done, they have given them the advantage of foreign exchange fluctuation adjustment because you are taking two different dates foreign currency rates. For the full value, you are taking today's foreign currency rate, and for cost of acquisition, you are taking the old foreign currency rate. Right, Anshul? Understood now? Good. Now we come to one more special point. Now this special point is relating to cost of acquisition. Now we have studied various scenarios of cost of acquisition, but I had kept this separately because this was different from all. Now this is applicable whenever what you are selling is either equity shares or units of equity oriented mutual fund. So in mutual fund, you have two types of mutual fund, equity oriented and debt oriented. So your mutual fund units which you are selling are equity oriented mutual funds. Now, what is very important in this is relating to shares, the condition is STT is paid on the shares both at the time of purchase as well as at the time of sale. And in case of units of mutual fund, STT should have been paid at the time of sale. Even if not paid at the time of purchase, it is fine. Now, if all these conditions are satisfied, today, when you are selling these equity shares, now I'm taking example of equity shares only, capital gain will be computed in the normal manner, but cost of acquisition has a special provision if these equity shares were purchased before this date. Now, what is the purpose or what is the reason of this particular provision? Because on this date, a major change happened in capital gains relating to equity share transaction which are happening through stock exchange. Now, what is this STT? STT securities transaction tax. Whenever you are purchasing or selling shares through stock exchange, the stock exchange levies this amount or it charges this amount, which is also a type of tax called as securities transaction tax. Now, prior to this date, that is 1st February 2018, all transactions happening through stock exchange where the asset transferred was a long-term capital asset and STT was paid prior to this date, the transactions were fully exempt. So what major change happened on this date? Now this is which date? This is the date of budget. So in 2018, when the budget was presented, a major change that was announced was that now onwards, the transactions happening on stock exchange would be chargeable to income tax. So what was exempt earlier, that exemption was removed. Now, since exemption was removed and it was taxable, so now you would be taking all the figures, full value, which is your today's sale price, no problem. Expenses on transfer, brokerage, commission paid to the broker. Yes, you have also paid STT, but you all know that STT is not allowed as deduction. So net consideration minus, now this cost of acquisition is what is the special provision over here. But this special provision is applicable only if the shares were purchased before the amendment and sold today. So in short, shares were purchased at that time when exemption was applicable, but it is sold today when exemption is withdrawn. So for such shares, this particular cost of acquisition provision is brought in. What does this provision says? Your cost of acquisition will be decided by comparing actual cost and this figure, and out of this you will take whichever is higher, actual cost or this figure. Now within this figure there are two figures. Out of both you will first take whichever is lower. Now you'll say, sir, what you are saying, higher, lower? So let me tell you, this is very similar to what we have already seen in cost of acquisition relating to 1st April 2001 assets. If you recall, 1 second, I'll show you. Yes. Now see, this is your special cases of cost of acquisition. And in these special cases, if the asset is acquired before 1st April 2001 and the asset is land or building, how do you find out the value? You have to take actual cost and one of this figure, and out of both these figures, whichever is higher. But before comparing both these figures, here you have two figures. You have to compare them and take whichever is lower. Exactly same is the provision for equity shares acquired before 1st 18. So same, how you have this provision, assets are acquired before 1st April 2001. Same thing is for equity shares which are acquired before 1st February 2018. You have this special provision. What is a special provision? Cost of acquisition is actual cost of acquisition compared with a figure, and you have to take whichever is higher. But here you have to compare two figures. FMV on 31st of Jan 18 that is exactly before the budget date, compared with your full value of consideration, that is today's sale price. And out of both these values, you have to take whichever is lower. So like how we were doing here, FMV on 1st April 2001, stamp duty value on 1st April 2001, comparing both, we were taking whichever is lower, and this lower figure was compared with actual cost, and we were taking whichever is higher. Same thing here, you have to find out the FMV on 31st of Jan 2018, that is immediately before the budget date, and today's sale price. Compare both, take whichever is lower. This lower figure will then be compared with your actual cost of acquisition and then take whichever is higher. So on similar lines, how you have this provision of 1st April 2001, on similar lines for equity shares which are acquired before 1st February 2018 and on which STT is paid both at the time of purchase and transfer. So for such equity shares, you have this special cost of acquisition. Is it understood, students? So these are the various provisions under capital gains. Students, anybody, any questions or doubts? Understood all? Clear? And then we come to the exemptions under capital gain. Yes. Yes, Harshal, you're right. I'm explaining for shares because you'll be getting sums for shares. So I'm mainly preparing this particular practical page, which I'll be sharing today, only from the perspective of exams revision. So I'm purposefully only including those pointers which are relevant for exams. So that unnecessary things you do not waste time in studying during exams or revising during exams. Fine, beta? Yes, Anchal. So here you first compare these two values, FMV on 31st Jan 18 compared with your full value, out of both whichever is lower. And this lower figure is then compared with your actual cost, out of both whichever is higher. Fine, Anshul? See, same, it is same like this case, what we were doing, where your land building was purchased before April 2001. Same logic is repeated here for shares which are purchased before 1st February 2018. So if you compare, you will be able to remember and understand it easily. Fine. Now let me take you to the last part. So as I was saying, you have to also check if your capital gain is exempt. Now, interestingly, for all other heads, the exemptions are only in section 10. For capital gain, there are two types of exemptions. First, section 10 and other, you have some exemptions given in these sections. Now, what is the difference between both these types of exemptions? See, section 10, whatever is exempt here, that particular income is out of the taxation net completely. In other words, whatever is covered in section 10 are those incomes to which you need not do any computation calculation because they are exempt at the source itself. However, this special exemption under capital gain is slightly different. So let me first explain you this. Under section 10 today, there is only one exemption applicable for capital gain, that is for compulsory acquisition. Now we have already seen compulsory acquisition is transfer. We have even discussed in the previous class a practical example of compulsory acquisition. Now, out of all compulsory acquisitions, only one compulsory acquisition is exempt. What is that one case? So you are a farmer and you have agriculture land. Now you are a farmer means what? Either you are an individual or you are a family. Now, if you observe in India, who are doing farming, they are doing in one of these capacities. Either the land is in your original individual name or it has been inherited, so it is in the family name. So when an individual or HF who is a farmer has a agricultural land, and this agricultural land is compulsorily acquired by the government. Same example, government is setting up bullet train track and your agricultural land is on the route. Now, when an agricultural land is compulsorily acquired by the government from farmers, whatever compensation, initial and in future enhanced compensation, whatever will be paid by the government to you, that will be fully exempt. So basically, this is a relief given to farmers that if their agricultural land are being compulsorily acquired, that compulsory acquisition will be exempted from capital gains. Now, this second type of exemption, which is unique to capital gain, not to any other head, because you'll not find this in any other head. This is only there in this particular chapter of capital gain. Now, in this particular exemption, the difference between section 10 and 54 exemption is, in case of section 10, if this scenario happens, you are a farmer, your agricultural land is compulsorily acquired, it is exempt, you don't have to do anything. 54 is slightly different. 54 exemption will start after you have completed capital gain calculation and you have got some capital gain. So FVC minus expenses minus cost of acquisition minus cost of improvement. So in all the cases of 54, what is important is you have to first compute capital gain. Now, once you get a capital gain, then you have to check whether there is any provision in any of these sections of 54 which are giving you exemption. Now, what is exemption here? Or I will say why there is an exemption here. In all these cases of 54, the exemption is given for reinvestment. So what all these sections of 54 say, that once you get a capital gain, we are giving you an opportunity to save your tax on that capital gain. How? You reinvest the capital gain. If you are reinvesting the capital gain, and then we have put some condition where you have to invest, what type of asset it should be. Once you fulfill that and you invest it within the time limits which are provided in the law, and if there is any amount limit, now amount limit is only in first case, other cases there is no amount limit. So when you satisfy all these conditions and you invest, I will give you exemption to the extent of amount invested. So this point of exemption will fall here. So like how we have done computation in all these different cases, you'll first complete the computation. Now you will check 54 to find out if there is any such option given of reinvestment. If yes, just follow the conditions, the timelines given, the nature of asset, what you should reinvest in, all these things. Once you check and satisfy, then let us say your capital gain was rupees 55 lakhs. And you followed all this and you invested in the new asset up to 40 lakhs. So straightforward 40 lakhs will be subtracted and the balance will be your taxable capital gain, which in this example is 15 lakhs. So the straightforward thing is you reinvest the money. Now, what are these different cases of 54? First case of 54 is where an individual or HUF has sold his residential house, which is a long-term asset, and has reinvested this amount in another residential house. So you should have utilized this amount. For what purpose? So you should have utilized the amount. What is happening? Yes. Sorry, there's some problem. Not able to write. ठीक है. Shall I just speak because there is some challenge in writing. So what they are saying that if you reinvest the amount, now where this amount has to be reinvested, it has to be reinvested in purchase or construction of another residential house. So the basic requirement is you have sold a residential house. So the asset sold is a residential house, and the new reinvestment should also be in other residential house. So if you're reinvesting in residential house, then as per 54, give you exemption to the extent of amount reinvested. Similarly, the next case of exemption is 54B, where what you are selling is agricultural land. Again, you are individual HF, and if you have sold this agricultural land, obviously this has to be in urban area, because if the land is in rural area, anyways, there is no capital gain because it is not an asset. Again, what they are saying, whatever capital gain you get, you should reinvest in another agricultural land within the time limit. So you have sold urban agriculture land, you get capital gain, reinvest in another agriculture land within 2 years. We will give you exemption to the extent of amount reinvested. Similar lines. What is the third scenario? What you have is industrial land or building. So you had purchased a land, you had constructed factory on that. Now that is compulsorily acquired. Wherever government is compulsorily acquiring your industry, that is the land and building belonging to your factory, then again the law says if you reinvest it in another industrial land or building within 2 years, you will get the exemption. Or if you are constructing new factory, it should be done within 3 years. So simple, if you observe what asset you have sold, if you are reinvesting in the same asset. So in first section, you have sold residential house, reinvested in residential house. Second case, you have sold agricultural land, reinvested in agricultural land. Third case, you are selling factory land or building, reinvesting in factory land or building. So where you are reinvesting, you are allowed these exemptions. Now in first three cases, you have to reinvest in the same asset. Now comes the next two cases. In 53, the law says what you have sold is a land or a building, but what you have invested or purchased is not a land or building. You should have reinvested in specific bonds. So what you are reinvesting in is specified bonds. These bonds are bonds of National Highway Authority, Rural Agricultural Corporation. So the names of these bonds are given. So in this particular case, exemption is given for reinvesting not in the same asset, but in a different asset. Students, there is some problem. Yeah. So 54 EC says what you are selling is land or building, but what you are reinvesting is some specified bonds, which is of National Highway Authority or Rural Electrification Corporation or Power Finance Corporation or Indian Railway Finance Corporation. So you should have reinvested in any of these bonds. And here the time limit is 6 months. So within 6 months, if you purchase any of these bonds, then up to 50 lakhs. So again, here there is a limit, like there was a limit in the first case up to 2 crores. Here there is a limit up to 50 lakhs. So up to 50 lakhs, we will give you the exemption. So in first three cases, you are supposed to reinvest in the same asset. In this fourth case, you are supposed to invest in specified bonds. And then comes the last case. In last case, interestingly, if you read what has to be transferred, it should be a long-term asset, but not house. So you can sell any long-term asset like shares, like jewelry, like commercial property. So what you have sold is any long-term asset other than house, but what you should purchase is a residential house. Now this is interesting. So what they want is this section is created for those people who are selling some asset so that they can purchase their house. So many times we have seen this. Till date you are staying in a rented house. Now over a period you have invested money in different assets like jewelry, gold, shares, and you are selling it to purchase a house. So this exemption is for them who sell any of their capital asset other than house to purchase a house. Now, why other than house? Because if you are selling a house and investing in another house, that exemption I have already given in the first section of 54. So definitely this section is not required. So if you are buying a house by selling a house, take exemption in 54. But if you are buying a house or constructing a house by selling your shares, your jewelry, your gold, your commercial property, that is any long-term asset other than a house, then exemption is given in 54F. So students, this is how 54 provides exemption. What is the special point in 54? The exemption is provided on reinvestment of the capital gains. So when you reinvest as per these conditions within the timeline, we give you exemption under 54. So students, this is the end of capital gains. I will request all to henceforth prepare, study capital gains so that whatever we have studied, discussed will get consolidated, right? Now let me go to the next topic, which is today's topic, that is income from other sources. Yes, just allow me a minute. Let us start, students. Yes, Isha, but I'll mention this. Once I complete the chapter, I'll upload the notes. So that will be done. No worries. Now we come to a small and sweet chapter, which is income from other sources. Why I'm saying sweet? Because first, it is small. So generally you find comfort. And second, because the format of computing income under other sources is simple. Now, what is this format? If I have to write it down, let us say here. See, as you can see, it is complete in 3 chapters, the format, 3 pages, the format is complete. So it is receipts minus expenses. This difference is income from other sources. So this list is of receipts. Okay, what receipts will fall under this head? Then you are given list of expenses which can be deducted, which cannot be deducted. So you have to first check what can be deducted, what cannot be deducted. So whatever are eligible expenses, that is, which are allowed to be deducted, you subtract them from the receipts. What is left is income from other sources. Now, section 56 is the charging section of this particular head, and it says that following receipts will fall under other sources: dividend, then income from betting, gambling, lottery, which is called as winnings. So first is dividends, second is winnings, third is compensation interest. Sorry, students, today there is some problem with my ratings. My pen is not working properly. Okay. Change. See, now we just studied in capital gains that whenever there is compulsory acquisition, the government pays you compensation, or through court, you may get this compensation increased. Now, the amount of compensation is part of capital gain. But what if this compensation is received late? If you are receiving it late, the government also has to pay you interest. The compensation amount is taxed under capital gain because it is compensation on some capital asset. But the interest on receiving this compensation late will be taxed to you under the head other sources. So third income which falls in other sources is your income relating to the interest on the compensation which is received late. Next is advance forfeited. Students, again, we studied this in capital gain. Now, if advance is forfeited before 1st April 2014, the treatment is you reduce it from cost of acquisition. So the treatment is under capital gain. But if advance is forfeited after 1st April 14, then capital gain chapter says treat that advance as your income from other sources. Then comes very important case which we refer to as gifts. So if you remember, is this happening today? Okay. So if you remember, we have a concept of gift. So wherever any money or property is received by way of gift, that will be taxed under the head other sources, right? Then comes the next scenario. What is this scenario? You are receiving compensation. Now, importantly, compensation is taxed under salary head also. Compensation is taxed under PGBP head also. Now, which compensation is covered over here? Obviously, it is the compensation which is not relating to salary head or PGBP head. Now, what is that compensation? So that compensation is, let us say, you are working in my company as a CEO. Now, if I have to give you compensation for the loss of your employment, like VRS compensation, retrenchment compensation, since your employer is giving you compensation, it will fall under your salary head. This is what you have studied in salary. However, let us say there is a competitor of me. That competitor wants you to leave my company. Why? Because you are a very significant employee in my company. In fact, my entire company's performance is dependent on you. Now, that competitor says, "Ki I am paying you 1 crore rupees, you leave this job." Now, when you are paid compensation in connection with again termination of your employment, so it is relating to termination of employment, but here the compensation is paid to you by a person who is not your employer, then it will fall in other sources. So where employer pays you compensation for termination of employment, it is income from salary. But where it is paid by a third person, it will be income from other sources. Next, whenever you will receive money under one of these policies. And important point to be noted is these are not exempt under 1010D. So whenever you will receive money under any type of life insurance policy and which is not exempt under section 1010D, obviously that has to be taxed. So such insurance receipts which are not exempt under 1010D will be taxed under the head other sources. Then there are few incomes which may even fall under PGBP. That is why the specific condition given here is if they are not chargeable under the head PGBP, then they will be taxed here. So some receipts which are not taxed under the head PGBP, then they are taxed under the head other sources. So first is your employees' contribution to Provident Fund. Second is interest on securities. Third is where you have given your property, your machinery, plant, etc. on rent. Fourth is where you have given your building along with plant machinery on rent. And last is some received under keyman insurance policy. So these are the five items which, if received in the course of business, are taxed under the head PGBP, but if not received in the course of the business, will be taxed under the head other sources. And then last is the residuary point. Any income which is not falling under the remaining four heads will be taxed here. So as you can see, the list is simple. Now out of this list, what is new to you is only three things. Remaining everything you can understand. Like winnings, we understand you get lottery, betting, gambling. We just studied capital gain, compulsory acquisition, compensation. The interest is taxed here. Advance forfeited also we studied in capital gain. Gift, dividend, though dividend is not new to you, but there is something special in dividend. So three things that we have to study specifically over here so that we understand other sources. First one is this gift. Second one is, first one is dividend. Second one is gift. And the third thing that you have to study is about this sum received under a life insurance policy. These are the only three things, students, where you need to understand it. All other things are very simple because they are simply common receipts that you may get. And only you have to check that it should not fall under PGBP, it should not fall under salary. Then it will be taxed under other sources. Now, what are the expenses that are allowed while computing other sources? Now here, first is where you are earning dividends, what we saw as our first income. Then if you are earning dividends, then only one expense is allowed as deduction, that is the expense of interest. Now you'll say, sir, how come interest be an expense in case of dividends? So I'll tell you. So let us say for investing in shares of a company, you have taken a loan, and on that loan you are paying interest. So now on the investment the company is giving you dividends, and for making that investments you had taken a loan on which you are paying interest. So this is that interest expenditure which we are talking about. Now remember one thing, for this particular case of dividend income, this is the only expense that can be deducted, that too with a maximum limit of 20% of the dividend received. So let us say this year you have received 1 lakh as dividend, and for investing in the shares you have taken a bank loan where the interest is 30,000. So 1 lakh is your dividend receipt, 30,000 is your bank interest. You will be allowed maximum 20,000. So even though your actual interest is 30,000, but the limit is 20% of such income. Such income means dividend. And besides this one expense of interest, no other expense is allowed to be deducted from the dividend income. So the very first income, dividend, is having a restriction of deduction. Then Next income is interest. Again, we saw above, if it is not taxed under PGBP, it will be taxed under other sources. In relation to interest, a common expense is given. So if you are making payment of any commission or brokerage or remuneration to any banker or any person for earning this interest, that will be deductible. Next, if you are having employees, whatever recovery you have made from employee towards their provident fund, if that amount is deposited within the due date of the respective act, you get the deduction. If you recall, this point we have already studied in PGBP also. So where you have employees, you have to deposit their provident fund amount. Now this provident fund will be deposited, one, from their pocket, that is by deducting it from their salary, two, from your own pocket. Now, whatever you are deducting from their salary, which is called as employees' contribution, that is to be first considered as your income. And then when you deposit this amount within the due date of the respective act, that will be allowed as deduction. Next item is where your income is rent. Rent from what? Rent from hiring of any of these assets. Now again, this will be your income from other sources. Now what are the expenses that you can deduct? So the expenses that you can deduct is of repairs, of insurance, so one is of repairs, second is of insurance, and third is of depreciation. So for renting income, there will be deduction of these expenses. If you observe what are these expenses, so you have given your asset on rent, and for maintaining that asset, you are incurring these expenses of repairs, insurance, depreciation. So against the asset income, the expenses on the asset is what is allowed as deduction. Okay, I have a question. Vedant is asking, then payment of PF is covered in two places. Yes, Vedant, you are right. But remember one thing, you will never be allowed deduction for the same amount twice. So what we just studied here in this Provident Fund wala case, the point to be understood and noted is that when you are running a business and you are having employees in that business, their Provident Fund deduction is in the PGBP head. But when you are running some activity which is not treated as business, in that particular case, even for doing that activity, you will require employees. But if that activity is not treated as business, then whatever contribution of provident fund of such employees you are collecting from them and depositing, that is allowed to you as deduction under other sources. I'll give you an example of this. So we just saw this another income. What is your income? Income is from giving your asset on rent. So you have some assets which you are giving on rent, and giving on rent is not your business. So firstly, this is not a PGBP income. Now, for these assets, for maintaining them, you have kept an employee whose role is that every day the employee will clean the asset. The employee will check whether the assets are properly running, whether any repairs is required. If repair is required, he will bring a technician or a mechanic and get it repaired. So you keep one person who is looking after that particular asset, who is your employee. Now, simple, if this asset is not used in business and this income is not part of business, then that employee whom you have kept for maintaining this asset is also not your business employee. So for such employee, this particular point gives you deduction. That is why I said similar deduction is allowed in PGBP. The difference is if your activity is business, then that employee becomes your business employee. You take deduction under PGBP. If that activity is not business, means that activity is falling under any one of this category. So all these things which are other sources income which we are studying now, if for any of these incomes earning, you have kept an employee to take care of that activity, then that employee is a non-business employee for you because you are not into business, and the provident fund contribution, etc. of that employee will be deducted here. Then comes an interesting case, that is family pension. Now, first, let us understand what is family pension. So, an employee gets a pension. Now, when an employee is getting a pension, it is only called as a pension and taxed in the hands of the employee under the head salary. But let us say the employee has expired and the employer continues to give the pension to the family members. In such cases, when the family members are receiving pension on behalf of the employee, that pension is other sources income for the family. Why? Because the family members are not the employee. So when they are receiving pension, they are not receiving pension as employee. So for them, it is not salary head, it is other sources head. Now in other sources, this pension which will be taxed is given a specific deduction. How much is the deduction? The deduction is lower of these two amounts. 33 one-third percent, or in simple words, one-third of the pension, or 15,000, whichever is lower. Now this 15,000 is increased to 25,000 if you are in the new scheme. So here, new scheme has a higher limit, old scheme has a lower limit. But these limits are to be compared with one-third of the pension, and whichever is less is what is allowed to you as deduction. Next, we just saw that whenever compensation from capital asset compulsory acquisition is received late, government will pay you interest, and that interest is covered under other sources. Now, for this interest, there is a flat 50% deduction. So whenever you are taxing interest on account of compensation received late, that interest will not be fully taxed. You have a straightforward 50% deduction. And then you have a general deduction which says any other expense which is not in the nature of capital expense and which is not covered anywhere else and which is done exclusively for earning the above incomes. So it is like the residuary section. So all expenses that you incur relating to earning above incomes, those expenses can be deducted here, provided they are not capital in nature. So these are various deductions. In this, important one is for dividend, where only one expense is allowed, that is interest, that too up to 20%. Then the second important deduction is for family pension, where a flat deduction of one-third or the higher or the maximum limit, whichever is lower, is allowed. And third deduction is wherever you get compensation late, and on that late compensation you are getting interest, that interest has a flat 50% deduction. Students, is this clear to all? Yes, anybody having any questions up to this point? I said this is a sweet chapter. It is simple, it is less lengthy, not having many technicalities, but still. Yes, Vijay, tell me. Yes, Gautami. See, technically there is no format here. What is the format? Let us say you receive dividend. So you'll write dividend in the inner column minus interest expense, if there is any. If not, we'll directly write in the outer column. So in majority of these cases, there will be no expense given. Only you have to keep in mind these two deductions, family pension and interest, because they are standard deductions. So whenever you are given family pension, write it in the inner column, subtract this one-third or 15, 25,000, whichever is low. Whenever you are given interest on late compensation, write it in the inner column, subtract 50%. Correct. So technically there is no format. As I said, it is a simple and a sweet head. You have to simply take the incomes. You have to remember which incomes will fall under the sources. So that you have to properly ensure that you are showing it in other sources and not in any other head. And wherever for these incomes, if any of these expenses are given, that you will consider. Main is you have to remember these two expense because they are standard deduction. Standard deduction means you have to take it automatically. One is family pension, one is interest on compensation. Clear to all? Anchal is asking which type of compensation, but it is that compulsory acquisition he studied in capital gain. See, it is covered here also above. This compensation, where it is this one. So it is the compensation or enhanced compensation. Which one? Which we studied in capital gains because of compulsory acquisition of your property. That compensation, whenever received late, the interest on that compensation is what is having this 50% deduction. Understood, beta? Anshul? Okay. What about others? Anyone? Any doubts or questions, students? Yes, please ask, Mehak. If you want, I'll unmute you. You can raise your hand, I'll unmute you. Mehak, what is your question, beta? I'm waiting for your question. So beta, raise your hand. Na? You raise your hand, I'll unmute you.
Am I audible, sir?
Yes, Mehak. Now
Sir,
you're audible.
sir, in question, there is a trading and P&L account is given. Then, sir, in debit side and credit side. So, sir, if any income or expenses in which is other head of the income, other head, sir. So, like PGBP or capital gain. So, at the time of the when calculate the PGBP calculation. So, if any incomes are other head, so credit side incomes are we deduct from net profit, sir.
Yes.
Okay, sir. And debit side, sir, it's add back, sir.
Yeah, if that expense is not a business expense, you will add
Okay,
it.
sir.
What is the
Okay.
reconciliation format for PGBP computation?
Okay, sir. Thank you, sir.
Sridhar, that we are going to discuss now. So relating to gift students, as I said, out of all these other sources of income, there are three incomes which we have to understand in detail. One is dividend, one is this gift, and the third is the family pension. This is what now I'll explain in detail. First, let me cover the list of expenses which are allowed and not allowed. Then I will go to each of these three incomes in detail. So you will get your answers over there, Sridhar, Aditya. Fine. Now, as we have a list of expenses which are allowed as reduction, on similar lines, you have list of expenses which are not allowed as reduction. Now, what are the expenses which are not allowed as deduction? So first is personal expense. Obviously, this cannot be allowed as deduction in any head. Second, wherever, now this second, this B, C, D, E, F, all these points are copy pasted from PGBP. So what we studied in PGBP is repeated over here. Now, B and C, what are these points? In B, what it says, you have paid interest. Interest is paid outside India. and you have not deducted the tax on it. So where TDS is not done for outside India payment, similarly you have paid salary. This is again paid outside India, and again you have paid this without TDS. So wherever you have paid interest, you have paid salary outside India, you should have deducted TDS. You failed to deduct TDS. Now recall PGBP head. Wherever you are making foreign payments and if you fail to deduct or deposit TDS, 100% is disallowed. Same point. Similarly, where you are making payment to a resident in India, again you are supposed to deduct TDS. Again, if you forget to deduct TDS or after deduction you do not deposit it within due date of filing returns, then 30% of the amount is disallowed. Same PGBP restriction. So even in other sources, the same restriction of PGBP is continued. So B, C, D, these 3 points are relating to TDS non-deduction, non-deposit, right? And same like PGBP, if the payment is outside India, 100% is disallowed. If payment is to a resident in India, 30% is disallowed. Then comes point E. What does point E says? Whenever you are making payment to a relative, we will allow you deduction. Condition is the amount should not exceed the FMV. If your amount is exceeding FMV, we will not allow you the excess amount. So up to FMV, expenses will be allowed if the payment is made to related persons. Yes, Ramakrishna.
Sir, could you please explain that C point and D point, sir? Because other than business, if suppose if not deducted TDS, then it will come under income from other source. Is it correct, my understanding?
See, firstly, Beda, understand one thing. You should first have income under the head other sources. Secondly, let us say you're talking about C. What does C cover? Salary. Now, this salary should be the salary of that employee whose income is covered under other sources. So firstly, you are running an activity like you are renting your assets. That renting is your other sources income. This is condition 1. Second, for earning this renting income, you have kept an employee. That employee is an employee from outside India and you are paying that employee salary. Then only point C will come. So until and
Other than
unless
business.
you
Basically, other than business, sir.
Yeah, so that's why I'm saying. Na? So,
Okay.
firstly, that is my first condition that income should fall under other sources. Because if it is falling under business, the same point applies, but it applies for PGBP head.
Okay,
Correct?
sir. Understood. Yes, sir. Yes, sir.
Perfect. Again, fifth point, F point is same students. What is F point? Wherever you are making payment in a day exceeding 10,000 to a person. Then what is the rule? The payment should be made only by way of account pay check, account pay draft, or through online medium which are prescribed like NEFT, RTGS, UPI, debit card, credit card, internet banking. So whenever payment in a day exceeds 10,000, same restriction of PGBP applies here also, that the payment should not be made in cash, should not be made by bearer check, should not be made by a simple cross check. If you are doing it any of these 3 ways, then the payment will be disallowed. So as far as the restrictions or disallowances are concerned, students, there is nothing new. All these things we have studied already in our PGBP restriction. So as Ramakrishna was mentioning, where these expenses are part of PGBP, they get disallowed in PGBP. Where these are not relating to business, that is, they are covered in other sources, and any of these restriction is happening, they will be disallowed here. Understood? So from B to F, all these disallowances are copy paste of PGBP provisions. Nothing new, nothing special. Now, for these income from other sources, there are few incomes which have special rates. So for winnings, whether it is from lottery, crossword puzzle, etc., or winnings from online games, there is a flat rate of 30%, which is the tax. And this 30% tax is without giving any deduction of any expense. So whenever you are having winnings income, that winnings income will be taxed completely without giving you deduction of any expense, and it will be taxed at the rate of 30%. Next special cases where at the time of raid, any such things are found with you, like any investment papers are found, money, bullion, jewelry is found, and you are not able to give explanation of its source. So whenever any unexplained item is found at the time of raid, then those items are considered as your income from other sources. And for such items, the law says you have to pay flat 60% as tax, and plus over and above 60% tax, you have 25% of this tax as surcharge. So for undisclosed incomes, we call them as undisclosed or unexplained. And generally this is found only at the time of raids. So whatever you have seen in movies on raids, whatever is found, that is what is taxed under the head other sources, because obviously that is undisclosed money. So source is not known. When source is not known, law assumes it is other sources. And what is important is there is a special tax rate of 60%, and that is obvious because it was your black money which you are to hide from the government. Other than these three, that is both the winnings and your undisclosed income, for all other incomes which we have seen under other sources like dividends, like interest, for all them, the normal rate of tax as applicable to you, that is a slab rate applies. What is very important for these three incomes, winnings, undisclosed income, for these three incomes, the rule is no expenditure or deduction is allowed. Chapter 6A deduction is also not allowed. Basic exemption limit is not allowed. Set off is not allowed. In short, as I said, these three incomes, two winnings and one undisclosed, these are taxable gross. That is, they are taxed fully and also at a special rate. That's it. So this is the best part of other sources. But in other sources, we have some important provisions because we have three important incomes that we need to understand. But before that, we will take a break. And after the break, I'll cover those three incomes in detail so that you will understand other sources chapter completely and with all its technicalities. Fine, students? Let us have a break. Now, we'll go to the details of these incomes. First point is method of accounting. Again, if you recall PGBP, we studied in PGBP, same point is repeated over here, that for income under the head PGBP and other sources, for these heads, the law provides you an option that you can either compute your income on receipt basis, which is also called as cash basis, or on accrual basis, which is also called as mercantile basis. So for both these heads, you are given a choice. Now, all these incomes which are taxable under the head other sources, out of that, 3 incomes we have to understand in detail because there is something important and relevant in them. Now, first income is dividend. See, normally speaking, you will say, sir, what is special about dividend? We know what is dividend. Dividend is the return on share. You are correct. But you have to understand, students, that in income tax law, dividend has been defined with a very wide scope. So what you understand normally as dividend, that is dividend. But besides that, there are some specific situations which will be deemed to be dividend. Now you will say, sir, why you have this special provision? Why we have to deem something as dividend? So let me first give you the background of this. So normally, whatever the company pays you at the end of the year out of the profits that the company has earned as a return on your capital invested is dividend, no doubt. But over a period, the government found that there were some methods adopted by these companies to evade tax, whereby they were giving dividends to their shareholders, but there was no tax liability on the shareholders. Those methods, those specific ways of giving dividends have been covered in the definition, and they have said that we will deem that these are also dividends. Now, what are they? So, normally, how we understand dividend? Let us say you have a share of 1 lakh. The company announces 10% dividend. You will get 10,000, which is in money form. If you are receiving something in money form, you'll understand that this is dividend. But over a period, government found that many companies, instead of giving it in money form, they were giving it in the form of assets of the company. So what companies were doing? They were giving away their assets, and they used to say that, okay, see, we are just simply giving away the asset. There is no question of dividend. This is only giving away of the asset. So the law said, no, this cannot be correct. So when you are giving away your asset, even giving away of asset of the company is equivalent to dividend. So the first special scenario is wherever the company gives away its assets. And obviously, the most important condition is that what company is effectively distributing is its profits only. But it is not giving it in the form of money. It is giving it in the form of some asset. So let us say the company purchases gold, and at the end of the year, it gives away gold in the form of gold biscuits, gold coins to the share member. Whenever the company gives any of the assets, then the market value of such asset given will be deemed to be the dividend income, right? Then comes the second scenario. Now here, interestingly, what company has done? Company has given away its own debentures, deposit certificates to shareholders, and it has given away bonus shares to its preference shareholders. Now what company has done? Company has increased its liability. See, when you issue debentures, you are creating a new liability in your books. So in the books of company, it has led to a new liability. But in your hands, you are the shareholder, you are getting a new asset in the form of debentures. If you are a preference shareholder, you are getting a bonus share, which you can tomorrow sell in the market and get money. So again, what the company was doing is, the company was giving away its accumulated profits. See, this is very important. Without accumulated profits, there can be no dividends. So company had accumulated profits, and out of these profits, the company, instead of giving you money, it gave away you its own debentures. Again, what it says, whatever is the market rate of debentures, that will be treated as your deemed income. Important point to be noted is, if bonus shares are given to equity shareholders, which is the normal case. So normally equity shareholders do get bonus shares. This will not be treated as dividends. Only if bonus shares are given to preference shareholders, only that will be treated as dividends. Third scenario is, the company is under liquidation. Now understand this point. When a company goes under liquidation, the shareholders are having the opportunity to claim their money at the end. Now, importantly, understand this, students, that at the end, when the shareholders will be given the money, it will not be only the capital of the company. Whatever is accumulated with the company, everything is given to the shareholder. Why? Because now the company is closing down. Whatever is there, everything belongs to the shareholder. Now, understand this point, that whenever the company is giving away anything to the shareholder at the time of liquidation, which again represents the profits, that is what the company has accumulated over the period. So over and above capital, whatever the company will give to the shareholders will also be treated as dividends. Similarly, whenever the company is going for reduction of capital, now again students will understand that at the time of reduction, the company will not only return the capital. If it is possessing any accumulated profits, along with the capital, it will also give you some share in the profits. So again, whatever the company gives you out of its profits at the time of reduction, that is nothing but giving away dividends in a different manner. Please understand, in all these cases, what company is effectively passing on to you is their accumulated profits. So first four case, company is giving you assets, company is giving you its own debentures, and in case of preference shareholder, it is giving bonus shares. Third, at the time of liquidation. Fourth, at the time of reduction, the company gives you anything out of accumulated profits. Now coming to the fifth scenario. Now in fifth scenario, what the company is giving you is a loan or an advance. Now this is very interesting. When a company gives you its loan or advance, and it is which company? It is a private company. Now, interestingly, income tax uses this phrase, company in which public are not interested. So it is a private company. So when a private company is giving loan or advance to whom? To such a shareholder who has 10% or more of its shares. So you are a major shareholder. So whenever the company gives you its company gives you a loan, but why it is giving you a loan? You are a major shareholder. And what is major shareholder? You have 10% or more of the equity capital. Then most important point, even this advance given is deemed to be a dividend if the company has accumulated profits. Now you will say, sir, above four situations were understood because you were getting some benefit, like asset, like debentures, anything. But here, you are not getting a benefit, you are taking a loan. So how can this loan be treated as dividends? So I'll tell you the logic. See, all these things have been added over a period of time after the government observed how tax is being evaded. Now visualize this situation. It is a private company. And in private company, we all know there is a limitation on shareholders. So let us say there are 30 shareholders. Now there are only 30 shareholders. And this year, the company has made a profit of 5 crores. It has to be divided between the 30 shareholders as per their capital. Now let us say I'm going to get rupees 50 lakhs as per my shareholding in the company. Now if I take that entire 50 lakhs, that will be taxable to me and I will be in the 30% bracket. So I devised a new, you can say, method of evading the tax. Now, since it is a private company, we are only the owners, we are running the company. So together we are shareholders decided that instead of taking the money from the company under the name of dividends, let us take it under the name of loan. So we will show in the books of the company that the company has given us loan. Fine. Now, interestingly, students, what the government realized was that over years, this loan was never repaid back by me to the company. And then slowly and suddenly they realized what I did effectively was I did not take a loan actually. In substance, this was me withdrawing the dividend money. Only on paper, I was showing it as loan so that it cannot be taxed to me because taking loan cannot be your income. See the logic, students. So the logic, the ideology is simple. I have taken a loan, at least on paper. Now, if I take a loan, then this particular provision gets triggered. This provision has two basic requirements, or I'll say three basic requirements. First, the company is private. Two, I am a major shareholder that is having at least 10% of the shares. And three, the company is having accumulated profits. So when all these three conditions are satisfied, then whatever loan I have taken and the amount of loan is within the accumulated profits amount. So it is well within the amount of accumulated profits. So the law says we will assume, we will deem that what you have done is nothing but you have taken dividend. It is then to be treated as your income, even though on paper you are showing it as loan. Correct? Now, in this provision, one more aspect was added. Now, if I take a loan, it becomes a dividend. Now, what I did is, I am myself not taking a loan, but I am asking some other entity. That entity may be HUF, firm, AOP, BY company, to take a loan from my company. Now, interestingly, the loan is taken by whom? The loan is taken by an entity, not me. But interestingly, in that entity, I am having at least 20% share. So if loan is given to me, it is deemed dividend as per first part. If loan is given to any such other entity, a partnership where my PSR is more than 20%, to some HUF where my share in that HUF income is more than 20%, to another company in which my holding is more than 20%, then the loan given by company to this other entity in which I am having more than 20% shareholding is also deemed to be dividend. So this is what is the special point relating to deemed dividend in this clause E. Yes, Ramakrishna.
Sir, no, exceptions, after exceptions I will ask, sir, because I have doubt that entity between two entities, if you have taken loan, then when it cannot be treated as a...
Okay, so let me then first cover the exceptions, then I'll take up questions. So two types of loans will be deemed to be dividend. Loan given to me. Who am I? I'm your major shareholder. Second, loan given to an entity in which I have a major stake, which is at least 20% of that company's or that entity's PSR. Now, in all these cases, the advance, the loan is treated as deemed dividend. However, if it is the business of my company to give loan, so who is my company? My company is a bank. So where a banking company is giving loan, the above provision is not applicable. Second, where let us say in some future year, so this year I have taken loan, in future year, the company declares dividend, but it does not pay me the dividend. Why? It adjusts the dividend against my loan. So here deemed dividend means your loaner. So when the company is actually paying a dividend in that year, when the company has declared the dividend, it did not pay me the amount of dividend. Why? It said that, well, you are already having a loan, so let me knock off the dividend against a loan. So whatever dividend the company declares, actually now they are giving dividend, but it is now adjusted against my deemed dividend. So in that year, there will be no tax on the actual dividend because now that actual dividend is knocked off against the deemed dividend, which is already taxed earlier. Correct? Very important point here. Even in subsequent period, even if I repay the loan, this will not change the answer. In the year in which I have taken the loan, it has to be taxed as deemed dividend. And even in future, the loan is repaid, there will be no difference in the tax treatment. So tax treatment is remaining the same. In the year of taking loan, I have to pay income tax, treating that loan as my deemed dividend. Correct?
But this the loan is a ordinary course of business.
Very simple. You see the MOA of the company.
Okay.
In MOA, we write business clause, address clause. We have different clauses. So see the business clause. If the business clause of MOA of the company says that the company's business or one of its business is giving loan, fine. You fall in the first exception.
Okay, sir. Okay.
Right?
Right,
That's
sir.
it. That is the only. Now we come to the F clause. Now this clause I need not explain because I've studied this very recently in capital gain. What is that case? When a company, which is a domestic company, buybacks its own shares. Now again, if you remember, I had explained this in the previous class itself, that whenever a domestic company buybacks the shares, now there is an amendment which is saying that these buyback of shares, whatever amount is paid by the company to me against the buyback of shares, will be deemed to be dividend and it will not be taxed under the head capital gain. So again, this point is connected to capital gain. So see, you will understand all these things very easily because it has been referred somewhere else and we just studied capital gain. So it is very fresh. So when a domestic company purchases its own share, that is, it does buyback, whatever amount it pays to me, the entire amount in my hands is deemed dividend. Most important, there is no deduction for any expense. Now the question is, what about the purchase price of the shares? Because I had purchased the shares. So if you remember capital gain chapter, the entire amount received will be treated as my deemed dividend. So whatever amount I have received on buyback is deemed dividend because of the amendment. That is this new clause F. And whatever was my cost of these shares, that is the price at which I had purchased these shares, that cost will be entirely my capital loss. So we studied this in capital gain in section 46A. So again, this is not a new point. Next, some more exceptions. The following will not be treated as dividends. First, distribution in respect of non-participating shares issued for full cash consideration. Means what? That whenever the company in the course of amalgamation, demerger, at that time also you will be giving some amount that will not be treated as dividends. Second, advance or loans between group companies. Now we all understand Reliance is a group, Tata is a group, Adani is a group. Within the group, if one company is giving loan to another, even though that other company is their shareholder, major shareholder, it will not be treated as deemed dividends. Next, distribution of share to shareholders at the time of demerger. So if a company goes into demerger, as we all have seen, we are given shares of the new company which has separated on demerger. Again, giving away shares at the time of demerger will not be treated as deemed dividends. So these are the specific cases which will not be treated as deemed dividends. Other than this, in all other cases, it is treated as deemed dividends. So students, this is the first important point in other sources, that is about dividends. I hope you understood all the different types of deemed dividends. In case anything is still not clear, you have any particular query, please feel free to ask. Students, anybody having a query, please feel free to ask. No? Now, one more point about dividends is on what basis dividend is taxed? That is, what is the charging year of dividends? Now, for this, the first simple rule is dividend is taxed in the year in which it is declared, distributed, or paid. So the simple rule is for regular dividends, it will be taxed in the year in which the company declares it or pays it. Second, in the case of deemed dividends, first four, it is taxed in the year in which company has distributed it. So the first four deemed dividends like assets given, debentures given, it is taxed in the year of distribution. Then the fifth item where you have taken advance or loan, it will be taxed in the year in which you are given that loan or advance. So taxability of deemed dividend, which is loan and advance, is the year in which the loan advance is given. And last, in case of interim dividends, it would be taxed in the year in which such dividend is received by you. Now they have used a language unconditionally made available. In simple words, it is received by you. So interim dividends is taxed in the year in which it is received. Harshal, I did not get your question, madam. Next point, rate of tax on dividend is normal rate. There is no special rate for dividends or deemed dividends. Correct? Now, we go on to the second important income under the head other sources, that is gift. Now you will find this appearing multiple times, gift. Now the question is whether gifts are taxable. The first straightforward answer is no. However, over a period, different amendments have been brought in, because of which the gifts in specified situations have been specifically treated as incomes. Now, presently, there are three heads in which gifts are taxable. First, in the salary head, where the employer is giving you any gift and the value exceeds 5,000 in a year, that is treated as perquisite income under the head salaries and it would be taxed to you. I hope you all remember this. So first gift which is taxable to you is gift received from employer exceeding 5,000. Yes, Ramakrishna.
Sir, 5,000 for one employee per year or?
Yeah. Per employee per year.
Okay.
It's not all employees combined. So every employee. So let us say you are also employee, I am also employee. So each of us up to 5,000 gift is exempt. Second is where in relation to your business profession, you receive any benefits, any gifts. So for example, you are a professional actor. Let us say Amitabh Bachchan. Now on the success of a movie, the producer gifts you an Audi car. These are all real life examples. Now, whenever you are gifted anything and that gift is arising out of your business or profession, I'll give you another example. We have the IPL matches, we have the cricket matches. At the end of the match, you are given either money or you are given some gold coin, something at the time of the presentation ceremony as man of the match award. Again, all these are examples of gift benefit arising out of your business or profession. One more example. You are a dealer of a company and on achieving the target, the company has given you a foreign tour package for you and family. All these are examples of gifts, benefits arising in the course of business or profession, and they are taxed under the head GDP. Yes, Harshal. So when we say accumulated profits for dividends, it includes the previous year profit also. So once the year is complete, that a profit becomes accumulated. So you're right, Harshal. Now coming to the third category of gift. Now students, there was no such third category which we are now talking about, which is other sources. So originally it was only salary and it was PGBP. Now in 2003 and 4, the government found out that people are evading tax. How they are evading tax? So let us say I have done something for you, and against that you have to pay me something. So what you are doing, instead of paying me as a consideration, you are showing that you are gifting me. Now in 2003 and 4, the government for the first time introduced the concept of gift in other sources, and at that time it was only money. As the government introduced that, suddenly what people started doing, instead of you giving me money, you gave me gold coin, you gave me some expensive watch, you gave me some property. So we continued with the same thing, but only the form changed. So that is why immediately the government brought in even property. Now, what is the section today? So whenever you are receiving any money or you are receiving any property, so it may be money, it may be property, it will be considered as gift if it is given to you without consideration, that is free, or for inadequate consideration. Now, what is inadequate? So for this, you need to have a fair price. You compare the fair price with the amount charged to you. And if the amount charged to you is less, we say that you are given that for inadequate consideration. Example, I show that I'm selling gold to you. I'm not showing that I'm gifting gold to you. I'm selling the gold to you. But the fair market value of that gold today is 1 crore and I am selling it to you only for 20 lakhs. So indirectly, I'm giving you a benefit of 80 lakhs. This is 80 lakhs is also a gift which will be in this second category. That is where we are not showing it as a gift because I have not given it to you completely free, but I have sold it to you. Still, it will be gift where it is sold for less than the fair price. So both situations are covered. Gift given as gift, that is without consideration, completely free, or something sold to you but for inadequate consideration. I hope this is clear. Now, two things are gift. One is a sum of money, so where monetary thing is given, or where any property is given. Now, in property, there are two types. One is immovable, so it may be land, building, or both, or it may be a movable property. Now, when it is a movable property, it will also be considered as gift, but for movable property to be treated as gift, it should be one of the property fitting in the definition given. So what is the definition given of property? So the definition given of property is either it is immovable, then it will be gift, no problem. But if it is movable, it should be one of these: shares, jewelry, archaeological collections, drawings, paintings, sculptures, work of art, bullion. Now, importantly, if I give you anything which is other than this, it will not fall in the category of gifts under this head. Example, I give you my motor car free of cost. I give you plant and machinery free of cost. Now you will find in this list no reference of motor car, no reference of plant machinery. So when any item which is not fitting in this list is given as gift, that will not be taxed. So you have to understand one point at a time. So firstly, what will be treated as gift? Money or property, which is either given free or which is sold to you but at a inadequate consideration price. So in one of these cases where money or any property is given to you, it will be considered as gift. But what property will be considered as gift? This list is very important. You have to learn the list because maybe in the question, they will purposefully include any such item which is not falling in the list. Like as I told you, motor car. Let us say there will be another example. They will purposefully say that somebody has given you mobile phone as gift. Somebody has given you a laptop as gift. Possible. But will these items be treated as gift under the head other sources? Answer is no. Why not? Because only two things can be considered as gift. Either somebody should pay you money, or if it is not money, it should fall in this list. So make the notes step by step. First requirement for being treated as gift under other sources is it should be money or it should be one of these properties. So you can call it as specified properties. Second requirement is either it should be given free, which we normally call as gift. So in the question also it will be given that I've given you as gift because that is what is free. Or second possibility, they will say that I have sold it to you, but I have sold it for a very low price. That is, it is an inadequate consideration. In that case, even though you are purchasing something, but if you are purchasing it for less than its fair price, that difference will be gift. Now the question is, what is the fair price? How will you determine whether I've sold it for a fair price or less than fair price? So for this, you have to check step by step. What is fair price for immovable property? It is the stamp value. So where anything is given to you below the stamp value, it will be considered as without consideration. Now, importantly, whenever it is given to you below the stamp value, try to recall PGBP and CG, where for land and building, we were comparing our agreement value with the stamp value. If you remember over there, all difference between agreement value and stamp value were not considered, only where your stamp value was greater by 110% of the agreement value. Only then it was considered to be a income over there. Same logic. If anybody has sold you a property, now when somebody is selling it to you, what you are going to check? You are going to check whether the consideration is inadequate. For this, you have to compare it with the stamp value. But while comparing with the stamp value, if the stamp value is higher than the sale price, no doubt the difference has to be treated as gift. But this difference will not be gift in all cases. You will first find out 110% of your sale price. Sale price from my side, purchase price from your side, whatever you can call it. If the stamp value is greater even by this 110%, then only you will say it is for inadequate consideration. So the requirement is that whenever immovable property is sold and it is sold for a price which is less than the stamp value and your price is even less than the stamp value even after making it 110%, then that only will be treated as gift. That is, it will be said that you have purchased this for inadequate consideration. When it comes to movable property, you have to check the fair market value to determine whether or not we will call it as inadequate consideration. So for movable property, what value should be taken to decide whether it is inadequate or adequate? It is fair market value. For immobile property, it is stamp value. In case of immobile property, you have to check that the difference should be beyond 110% of the purchase value, then only it will be treated as gift. For movable property, there is no concept of 110%. So here, for any amount or difference, if your fair market value of the property is higher and the price at which you have sold this property to the other person is lower, it will be considered as gift. Means for immovable property, the stamp value should exceed 110% of the consideration. Only then we will say that you have sold for inadequate consideration. And for movable property, it should exceed, the fair market value should exceed. Here, there is no requirement of 110%. Now, as you can see in all these points, there is 50,000 written. Now, what is this 50,000? So see, we are understanding gift step by step. First, what can be gift? Money, property. Which property? Specified property. Second point, when it will be gift, one, either it is given free, which is we call as gift, or it is sold for less than fair value. What is fair value? That is third point. In case of immovable property, it is stamp value. In case of movable property, it is fair market value. But for immovable property, stamp value should be compared with 110% of the consideration. If stamp value is greater, then only it will be called as inadequate consideration. Now, the next point in gift is a small amount of gift is not taxable. So firstly, gift is taxable, yes, but then there is a amount criteria. A gift will be taxable only if the amount or value of gift exceeds 50,000. Now, it means that if somebody has gifted you, let us say somebody has given you a small jewelry item, which is of 28,000, it will not be treated as gift. Though it is gift, though it is satisfying all our other conditions. But the law wants that we do not want to tax minor or small amount gifts. We want to only tax major amount gifts. So they have kept the limit as 50,000. Now, how to apply this 50,000, that we are going to understand. Before that, any questions up to this point? Yes, Aditya.
Sir, I have one doubt, sir. If gift given for spouse and any family member for a flat or anything that cash, it comes to others also. But if they give 70,000,
Sorry,
80,000,
sorry. Aditya, please listen.
hmm,
Repeat
hmm.
whatever you said because your voice was very cracking. Please repeat.
Sir, audible, sir, ಈಗ? Audible? I am audible?
You are audible, only your voice is cracking, so I am not able to clearly understand what you are saying. So please repeat it slowly so at least I'll understand.
Sir, if anyone gives, friends gives any gift as a cash, gift as a flat, how much it is exempt or how
As,
much it is
as a, as a,
taxable? Taxable, how much it is exempt, sir? My question is, how much it is exempt for any gift, sir? Exemption.
so this is what we are saying now, 50,000. What we are discussing that only. So if your friend
Yes,
is
sir.
giving you a gift and if the value is up to 50,000, it is not taxable. That is what exactly we are discussing, Aditya.
Yes, sir. Yes, sir. Sir,
That
if
is what,
house property, sir, house
huh?
property, but it is if anyone gives a house or any flat, but it comes to other source or house property, sir. Gift given as a flat or house.
See, beta, if it is gift, it will come to other sources only. Why it will go to house property? In house property, we never studied that gift is taxable. What is taxable in house property is only the rental income. Now, if somebody has sold you the house or transferred the house in your name, then it can only be taxed as gift income if that house is transferred in your name either free or for less than the stamp value amount.
Okay, okay, clear, sir, clear. Thank you.
Okay. Now, students, an important point about this 50,000. Now, how to check the limit of 50,000? Let us say it may happen that during a year, 6 different persons have given me money. 3 different persons have given me movable property, let us say jewelry, and 1 person has given me immovable property. So I have received gift of all these categories. How to check the 50,000 limit? So here, students, remember one thing. 50,000 has to be checked for 5 different categories. First category is money. Now, whenever you are receiving all different types of gifts, don't club all of them. Check category wise. What is the first category? Money gift. Now, in case of money gift, how to check this 50,000 limit? This 50,000 limit will be checked. One second. How this 50,000 limit will be checked? That whatever money you have received during the year, add up all the amounts of money you have received. If all the amounts of money that you have received is above 50,000, it will be treated as your first gift income. Which means what? As I said, I have received money from 5 different people. Somebody gave me 12,000, somebody gave me 10,000, somebody gave me 15,000, somebody gave me 9,000. Add up all the money which you have received free, that is as gift. If the total of all the money exceeds 50,000, it will be income. If the total of all the money is not exceeding 50,000, it is not income. Now, while finding out this 50,000, I'm only adding all money. I'm not clubbing all the 5 categories of gift. I'm going category wise. First category is money. Correct? So whatever money gifts you have received during the year from different persons, add them up. That total, if that total exceeds 50,000, it is income. If it does not exceed 50,000, it is not income. Then comes the second category. Second category is what? Somebody has given you movable property and that movable property is given free. Second is this. Third is if movable property is given means sold to you for a lower price. So see, we have 5 categories. What are those 5 categories? Money gift, movable given free, movable sold for inadequate consideration, immovable given free, immovable sold for inadequate consideration. So these are the 5 categories of gifts. For all these 5 categories, 50,000 limit is there, but 50,000 limit is for each of these categories. You will not club all the 5 and check 50,000. You will go category wise. So only add all the money items. If the total of the money items is 50,000 plus, treat it as income. Second category is whatever movable property people have given to you and they have given to you free. That is your second category. So in second category, you will cover only those movable properties which are given to you free. Find out their fair market value, add up all the fair market value. If the aggregate of the fair market value of all the movable property given to you free exceeds 50,000, it is gift. Right? Third category. What is the third category? The third category is you have purchased removable property but for a lower amount. What is the lower amount? As I said, you have to compare it with fair market value. If you have purchased property for a lower amount, the difference between the fair market value and your consideration, this difference is gift. But how you have to find out this? Let us say in this year you had purchased 2 movable properties. One is jewelry and the other is shares. And both these are purchased for less than fair market value. Whatever is the difference. So let us say jewelry you purchased 20,000 less than fair market value. Shares you purchased 28,000 less than the fair market value. Add up both these. So both these differences is 20 plus 28, 48,000. Is it exceeding 50,000? Answer is no. It will not be considered as gift. But let us say the difference of jewelry is 20,000. The difference of shares is 30,000. You have, sorry, not 30, 35,000. You have added up both, it is 55,000. Now, this difference of 55,000 will be treated as gift. Which gift? The third category gift. So see, we have 5 categories of gifts. Each have to be checked independently for deciding 50,000 limit. First is money category. Second is movable given free. Third is movable given for less than fair market value. Is this clear? Fourth category, you have received immovable property and it is given to you free. Now, when it comes to immovable property, you have to check the independent value of each immovable property. So in the first three categories, we were making aggregate of money, aggregate of movable free, aggregate of movable purchase for less than the fair market value. We were aggregating it. Now, when it comes to immovable, the fourth category is where you have received immovable property free. Here, whatever immovable property you have received free, find out the stamp value, and that stamp value, if it exceeds 50,000 of that one property, it will be treated as gift. And the fifth category is where you have purchased immovable property but for less than stamp value. Then find out the difference between the stamp value and the consideration. If this difference is exceeding 50,000 for one property, that difference will be called as gift. So how do you check this 50,000? You have 5 buckets, and for each bucket you have limit of 50,000. You have to check 50,000 bucket wise. You will not add up all these 5 categories of gifts to check 50,000. Is this clear, students? Understood? Vedant Beda, what is 2.5 lakhs? What is 2.5 lakhs, Vedant? I'm not getting. Now, students, this is the exception list, if I can call it. What is exception list? If you have received gift in any of these scenarios, irrespective of the amount, it will not be taxable. So here, even if crores of rupees have been received as gift, it will not be taxable because these are specifically excluded from the section. Correct? Now, one thing I had mentioned earlier, the gift should be falling in the list of the properties which are mentioned. So if you receive any gift which is not falling in the list, like wristwatch, like laptop, like plant and machinery, like motor car, all these are not falling in the list, so they will not be gift. Similarly, if the gift is falling in one of these situations, it will not be treated as income. What is that? First, when the gift is given to you by your relative. So when your relative gives you a gift, it is not to be taxed. First case of exception. No, Isha. For immovable category, you will not sum up. It is each property wise you have to check. Yes, good question, Harshal. So Harshal is asking, sir, what if my value exceeds 50,000? So whether the total amount is tax or the amount in excess of 50,000 is tax. So let us say I receive a gift of 75,000. Now in this case, how much is tax? Now this is exceeding 50,000. How much is tax? Entire 75,000 is tax. 50,000 is not a deduction. 50,000 is only a criteria given to decide whether this gift will be income or not. Once it exceeds 50,000, entire amount is taxed, not only difference above 50,000. Fine, Harshal? Now, coming to the exclusion list. So where gift is received from your relative. Second, it is received at the time of your marriage. So at the time of marriage, people give a lot of gifts. So whether they are relative, whether they are unrelated, every case where it is on the occasion of marriage. So it may be given by anyone. See, relative is a separate exception. Occasion of marriage is a separate exception. So in case of relative giving at any time, not necessary marriage, any time, it will not be gift, not be taxable. Similarly, any person giving you the gift on your marriage, that is also not taxable. Third, where you have received a gift by way of will or inheritance. Four, In contemplation of death. What is in contemplation of death? So let us say a person is going to die, and at the time of death, that is, she's on deathbed, the person calls you and say that I want to give you this. So when person giving you gift, because the person is expecting, contemplation is expectation that the person will die. So whenever the person is contemplating that the person will die, and at that time the person gives you some gift, that gift will be treated as your non-taxable receipt, because gift received in all these scenarios is not taxed. So this scenario is contemplation of death of the taxpayer. Correct? Now come some scenarios which are only theoretical, so you may not take the pain of learning them. Just remember the names. What are the names which are not taxable? So you have received a gift from local authority, from any foundation, university, education institution, hospital, trust, any institution, university, medical association, or those transactions which are not regarded as transfer. If you remember, 47 list is not transfer list, from an individual by a trust created, established solely for the benefit of the individual, such class of persons as the government may prescribe. Next, where any individual has received gift, why? On account of medical treatment of himself or family members at the time of COVID. If you remember, during COVID, the government was giving a lump sum amount, and by a member of a family of a deceased person, from the employer of the deceased person, or from any other person, again relating to COVID-19. So at the time of COVID-19, either your employer was giving or any person was giving you an amount, that is not treated as gift. So I have marked what are the important situations. You will get one of these situations in exams. You have to remember this list, then it will not be taxed. Yes, Ramakrishna, you have some question. Go ahead.
Sir, relative definition is not given, sir, from
Relative definition is given. We are coming to that definition. Don't worry, it is given at the end. We are. Anchal is asking, sir, suppose if we get jewelry in the form of gift and a painting in the form of gift. No, beta. See, jewelry and painting both are movable. See, we have 5 buckets. Now, your both examples are falling in the second bucket. What is that bucket? You have received something which is movable and which is given to you free. So movable free is your second bucket. Now, whatever fits in the second bucket, you have to add all those things and then compare it with 50,000. Correct? Kambira says, sir, how to find that the given at the time of marriage and period like after marriage? See, importantly, Kambira, they are not saying it is given on the date of marriage. It is given on the occasion of marriage. It is given you some days before marriage or some days after marriage. It will be still treated as on the occasion of marriage. They have not used the word date, so it may need not be only at the time of marriage. It can be given before or after. Now, who are relatives for the purpose of this section? So your spouse, that is your husband or wife. Second, your real brother, your real sister. Second, your brother-in-law, sister-in-law, because they are the brother sisters of your spouse. Then your uncles and aunties, that is your brother sisters of your parents. So uncle and auntie from your mother's side, uncle and auntie from your father's side. Then your lineal ascendant. What is your lineal ascendant? Father, mother, grandfather, grandmother, great grandfather, great grandmother, both side, mommy side and daddy side. Then your lineal descendant means your children, your grandchildren. Similarly, lineal ascendant descendant of your spouse. So say your parents who are father-in-law, mother-in-law, grandfather-in-law, grandmother-in-law, because they are lineal ascendant of your spouse. And last, spouses of all the above persons. So if you have considered your brother-in-law above, then brother-in-law's wife. If you have considered your uncle, then uncle's wife, that is your auntie. All these are relatives. And if you are receiving any amount from them, whatever is the amount, it will not be taxed because gift received from related persons is not taxed. And last is if you are HUF, then any family member of the HUF is your relative. So students, this is the whole point about gift. So For gift, you have to first check whether there is money or any type of property. Property should be one of the specified properties. Second, whether it is given free or it is sold to you at a lower price, lower than fair market value for movable and lower than stamp value for immobile. In case of stamp value, you have to take 110% to compare. So once both these conditions are satisfied, it will be a gift, but then the amount comes. Only gifts exceeding 50,000 will be taxed. So there are 5 buckets given. You have to find out 50,000 for each bucket separately. Then the next point is there are some exclusion cases where if the gift is received in any one of those exclusion situations, it will not be taxable because it will not be treated as your income. So these are the different aspects relating to gifts. Fine, students? Yes, any questions or doubts?
Sir, one more doubt, sir.
Please.
Sir, suppose suppose a person having 2-3 properties, and one property is given as a gift to the wife. From wife, then getting rental income. So it cannot be clubbed under individual, sir.
Correct.
So,
But that is a point. See, firstly, you have gifted the property to your wife. Is this gift income?
no,
Firstly, you have property, you have given to your wife. Na? So firstly,
yes,
giving this property as gift to your wife, is this income under other sources?
no, sir.
Correct? Good.
Correct.
Now in future, your wife will earn rent on this property. Now this
Yes.
rent, you will study in the chapter of clubbing that this rent will be treated as your income, but that is not a gift. That is the clubbing part which is covered. Correct?
Correct.
So it will be income because of clubbing. So you are correct. So there are two things. In this year, I have given the property. Giving of property to wife, is it taxable gift? No. Why? Because wife is fitting in the relative definition. But then the next part in future, whatever rental wife will receive on this, that rental will be your gift, your income as per clubbing provisions. Correct?
Yes, sir. Okay, sir.
Perfect. Yes, Aditya.
Sir, I have one doubt. If anyone give me a gift, who will pay the taxes? A gift receiver or gift payer, sir?
Tell me one thing, who is getting the benefit?
Sir, I am getting the benefit if I
Who
am
will pay?
receiver.
Always the person. See, what is income? Income is a benefit. So income tax is always to be paid by the person getting the benefit, that is getting the income. So in case of gift, who is that person? It is you.
Okay.
Simple, na? So students, we have completed the major aspect of other sources. I have explained you the entire list of incomes, expenses, which are there in other sources. Plus, we have gone to the important types of incomes under other sources. One is dividend, one is gift. You can expect question on one of them in the exams. Please understand all the aspects. You have to apply the provisions by going to all the aspects like 50,000 calculation, whether relative or not, whether the asset is property or not. After applying all the provisions, you will conclude, you will decide whether that gift will be taxable or not. So in other sources, there is no much computation, but these are some important points. Like in case of dividend, we studied. In case of family planning, we studied. So there are few provisions, conditions, requirements that you have to keep in mind. Once you do that, other sources solving wise is very simple because you have to simply take the receipt minus the deduction which is allowed. The difference is your other sources income. So with this, we close today's session. So we have completed this. The remaining smaller types of incomes, what are explained, you can study it by yourself. I'm sure you'll understand it. And in case still, if you have any doubts, we are always there to resolve your doubts. But for that, please keep revising, keep studying. That is the most important thing at your level. So with this, I conclude my today's session. Thank you, students. Thank you very much. Thank you all. Yes, Sanket ji, we can close. Thank you, Sanket ji.